Welcome to the deep dive. Ever wonder how these huge companies, manage that incredible balancing act
Mm.
between driving growth, pushing tech boundaries, and crucially, making sure there are solid returns for you, the shareholder?
Yeah, it's more than just profit, isn't it? It's really about their strategic vision.
Exactly.
And our mission today is, well, to pull back the curtain on exactly that. We're diving into the recent performance and the dividend strategies of three really interesting but very different players.
Okay, who are we looking at?
We've got CNOOC, limited major energy powerhouse.
Sure.
Then NetEase, a big name in tech and entertainment.
Right.
And finally, the Industrial and Commercial Bank of China, ICBC. A giant in finance.
Three very different sectors.
Absolutely. So we'll sift through their latest reports, their policies, and try to pull out the key nuggets, what drives their success and how they handle value for stakeholders.
Okay, sounds good. Let's start with CNOOC Limited then. An energy giant, as you said. Making some pretty big moves in global exploration, especially deep water, but also focusing on green initiatives in 2024.
That's right. And what's really strategic about CNOOC, I think, is how they're pushing beyond let's say, the easier oil and gas finds. Take the Bohai Sea. They're using some really innovative thinking, new tech, in what they call the extensional strike slip fault composite zone.
Okay, that sounds complex.
It is basically a very tricky geological area with lots of intersecting faults. So it's not just finding new stuff, it's unlocking resources that were, pretty much inaccessible before.
And they're getting results from this.
Oh, yeah. They've announced new discoveries like Longku 7-1 and successfully appraised Bozong 8-3 South.
Right.
And what's really impressive is how quickly they turn these finds into production. They use something called rolling exploration.
Rolling exploration, what does that entail?
Well, it's key. It basically means they use data from existing wells almost immediately to find and develop reserves right next door.
Ah, okay.
So they move super fast from discovery to actually pumping oil or gas. Cuts out a lot of delay. It's very efficient.
Makes sense. And their ambition in the South China Sea? A 1 trillion cubic meter gas region goal. That's huge.
It really is. And it's driven by their new ideas about how hydrocarbons gather deep down. They've already found Huizhou 19-6.
Which is?
A massive 100 million ton oil field, deep play. Shows massive potential down there.
Wow.
And it's not just finding it, like I said, it's getting it out. They figured out how to develop these deep reservoirs where the rock's porosity, the trainee spaces are kept open by immense natural pressure.
A technical challenge, I am
A
out.
huge one.
Right.
But this breakthrough allowed one of their wells, Wuxi 16-5, to produce at a really high rate. That's a major win for developing these tough, deep reservoirs.
And they're not just staying close to home, right? They're expanding overseas.
Definitely. They're very focused strategically on the Atlantic Rim and also countries involved in the Belt and Road Initiative.
Any highlights there?
Yeah, they found another 100 million ton discovery called Bluefin. So that expands their international resource base significantly.
So, looking bigger picture, what are we talking total resources?
It's impressive. About 11 billion barrels of oil equivalent, total recoverable resources. And they're projecting 8 new projects coming online by 2030.
Okay.
That should bring total production to around 1.3 million barrels a day, with capacity up to 1.7 million.
And this includes places like Guyana?
Yep, progress in the Stabroek block there, plus new contracts in Mozambique, Brazil, Iraq.
Right.
They operate in 7 blocks across those. They're definitely thinking globally.
So while they're out there exploring aggressively, they're also really optimizing what they already have. Sounds like operational brilliance.
That's a good way to put it. Their net proved reserves just hit a record high, 7,271 million barrels of oil equivalent.
Wow.
And get this, a reserve replacement ratio of 167%.
167%. So they're finding much more than they're producing.
Exactly. And their reserve life is holding steady at 10 years.
How are they managing that with existing fields?
By being meticulous. They finally map out the reservoirs, understand them inside and out, and use that continuous rolling exploration we talked about, really squeezing everything they can from mature assets.
And the efficiency gains, those numbers are pretty striking, bringing the natural decline rate down from nearly 10% to just 1.2%.
Yeah, that 1.2% figure is incredible. It comes down to optimizing how they inject water to maintain pressure and really controlling the water cut.
Water cut being the amount of water versus oil.
Precisely. Less water, more oil, better efficiency. It shows just masterful control over existing fields extends their life dramatically.
And they're tackling low productivity wells, too.
Right, and improving uptime through really fine-tuned management. They gave this example comparing their imaging tech now versus 2004. The difference is just night and day.
Which brings us nicely to their engineering and tech side. New projects coming online.
Several big ones. In Bohai, the Suzong 36-1 Luda 5.2 project hit over 30,000 barrels a day. And interestingly, it uses onshore green electricity.
Green power, okay. And Brazil.
The Mero 2 and Mero 3 projects both started production, each aiming for 180,000 barrels a day. That's a significant boost.
And day-to-day efficiency is up, too, drilling faster offshore China.
Best level in 5 years, yeah.
What's driving that?
A huge factor is engineering standardization. Standard design, standard processes.
How much impact does that actually have?
Well, listen to this. It sped up building production capacity by 27%.
27%? That's massive.
It is. And it cut costs by 5% through bulk buying. They even optimized platform designs to cut weight by 1,900 tons and shave 2 months off the manufacturing time.
So faster, cheaper, lighter.
Directly impacts the bottom line and project timelines. Makes them much more competitive.
And they're getting recognized for this innovation. National awards.
Yep. First prize for the Shanghai 1 ultra-deepwater gas field development. Second prize for their Bohai deep exploration tech. These aren't just, pats on the back. They signal real leadership.
Right, tackling the toughest challenges.
Exactly. And they've commissioned other key tech, too. A shallow water subsea system in Bohai. The Reka 1 mobile heat and injection platform boosted thermal output massively.
More efficient heavy oil recovery, presumably?
Precisely. Plus, groundbreaking stuff like Haikui 1, their first cylindrical FPSO.
A floating production unit.
Right. And Haiji 2, the tallest deepwater jacket platform in Asia. These are major infrastructure milestones.
So CNOOC isn't just sticking to traditional oil and gas thinking. They're really pushing into digitalization and green initiatives, too.
Heavily invested. They're moving fast on unmanned or less manned offshore platforms. They've set up Shenhai 1 down south and Qinhuangdao 32-6 up north as benchmarks for smart fields.
How are they managing that transition to smart fields?
A key part is their Haining AI model.
Ah, artificial intelligence.
Yep. It integrates digital tech across their operations, allows for much more seamless control of development and production, onshore and offshore.
And the green results. You mentioned green power earlier.
They're genuinely impressive. Consumed over 760 million kilowatt hours of green electricity. Recycled over 50,000 cubic meters a day of flare gas.
Turning waste gas into something useful.
Exactly. And their floating wind power platform, Haiyu Guanlan, is generating power steadily, 26 million kilowatt hours so far. Plus, they're building the world's first 16-megawatt tension leg floating wind platform.
So a serious commitment to renewables integration.
It seems so. And it raises this question about their long-term strategy, doesn't it? They're not just greening current ops. They're actively promoting carbon neutral, even carbon negative sectors.
Like carbon capture, CCUS.
Right. They're developing 2 offshore CCUS bases, Bohai and Hainan, already injected over 110,000 tons of CO2, and launched China's first offshore film decarbonization CCS project.
Film decarbonization.
Yeah, a specific technology for capturing CO2. Point is, they're clearly thinking seriously about the energy transition.
Okay, so all this operational strength, the tech leadership, how does it translate financially?
Pretty directly. Their profit from operating activities and profit before tax were both up a healthy 10% in 2024.
Solid growth. And for shareholders.
They delivered. HK $1.48 per share dividend for 2024. Plus, they bought back over 36 million shares in Hong Kong, returning capital. And looking ahead, they've committed to a dividend payout ratio of at least 45% from 2025 to 2027.
A clear signal.
Yeah, with flexibility built in. But it shows confidence and a commitment to returning value.
Okay, so CNOOC paints a picture of, well, operational strength driving financial health and shareholder value. Now let's shift gears. Let's look at dividends through 2 very different lenses. NetEase, the tech giant, and ICBC, the financial titan.
Right, this is a really interesting comparison.
So NetEase first. What's their approach? They pay $2.76 per share annually, about a 2% yield, paid quarterly. Seems fairly standard so far.
It does, until you look at their payout ratio.
Which is?
A whopping 199.03%.
Whoa, wait, 199%. They're paying out almost double their earnings.
Exactly. And for a tech company, that's, well, it's highly unusual.
What does that even mean? How is that sustainable?
That's the million-dollar question, isn't it? It could signify massive confidence in future profit growth. Or maybe it's a strategic choice to return a lot of capital now, perhaps if they feel they're in a more mature growth phase.
Or drawing down reserves.
Or drawing from accumulated reserves, yeah. Whatever the reason, it's a bold signal to the market.
But they are growing the dividend, despite that ratio.
They are. About 6.6% growth over the last year and 3 straight years of increases.
Okay.
And if you add in share buybacks, their total shareholder yield is just over 3%. So even with that high payout ratio, value is being returned.
Interesting. A very dynamic approach. Now compare that to ICBC.
A completely different world. ICBC operates under a prudent and very heavily regulated dividend framework,
Regulated by whom?
primarily banking regulators. While the shareholder meeting formally decides the dividend, the decision has to consider a whole raft of factors.
Like what?
The results, obviously. Cash flow, financial health, capital levels. Those capital adequacy ratios are key for banks' future prospects and, crucially, very strict legal and regulatory rules.
So regulation plays a huge part.
A defining part. Before they can even think about dividends, profits have to be appropriated in a specific, mandatory way.
Appropriated how?
Well, first, 10% has to go to a statutory surplus reserve.
Okay.
Until that reserve hits 50% of their registered capital. That's step one.
And there's more.
Oh, yes. Then appropriations go to a discretionary surplus reserve, if shareholders approve. And then there's a general reserve mandated by the Ministry of Finance.
Another reserve.
Right. At least 1% of year-end risk assets, usually funded by taking 20% to 30% of net profit after certain other steps. All of this happens before any profit is deemed distributable as dividends.
So multiple layers of reserves built up first.
Exactly. It's not just accounting. It's a fundamental regulatory structure designed for stability. Protect the bank. Protect depositors. That's paramount for a systemically important bank like ICBC.
And dividends only come from what's left, the distributable profits.
Precisely. Which is defined as the lower of their profit calculated under Chinese accounting standards or international standards, plus any carryover, but only after all those mandatory appropriations.
Makes sense.
Anything left that isn't paid out just stays there for the future.
And there's one more layer of protection, regulatory oversight.
The final backstop. The banking regulator, the CBRC, can step in and restrict dividends entirely if the bank's capital ratios fall below certain thresholds, 8% total adequacy, 4% core adequacy, or if they break other rules.
So stability trumps payout.
Absolutely. Financial stability and systemic resilience are the priority. It's characteristic of how large regulated banks operate globally, but especially one of ICBC's sheer size and importance.
So what does this all mean for you, the listener? We've seen CNOOC, aggressively exploring, innovating with green tech, but still focused on shareholder returns.
Right. Then you have the contrast. Needies with that really high payout ratio, suggesting maybe confidence or a mature phase.
And ICBC operating squarely within that tight regulatory box designed for financial stability above all else.
Exactly. These examples really highlight how the industry a company is in and the rules it has to play by profoundly shape its choices. Growth, innovation, how it shares success with you, it's all interconnected.
The rules of the game are just different.
Completely different. And understanding those differences is pretty critical if you want to grasp a company's long-term prospects, wouldn't you say?
Absolutely. So here's a final thought to maybe chew on. As the world deals with huge shifts, energy transitions, digital disruption, economic uncertainty, how might the different strategies of CNOOC, Needies, and ICBC position them for whatever unforeseen challenges come next?
Yeah. And what could their very different approaches to shareholder returns mean for their long-term resilience?
Yeah.
And for your potential investment?
Something to think about.